In order to produce $500 billion worth of AI infrastructure requires enormous amounts of investment from a lot of different partners.
Nvidia's revenue and profit growth have been nothing short of spectacular, but the business still faces risks. Nvidia's CEO Jensen Huang just said something that should make every investor pause. China is not behind anybody. That's not just a headline, it's a warning. Nvidia has been a monster stock, rising 1,480% just in the past 5 years, but it experienced significant volatility this year. And as of this video, shares trade down 17% since January 1st. The business has become the poster child of the artificial intelligence AI boom, providing powerful graphics processing units, GPUs, that help run training and inference models. Revenue and earnings are soaring. In a world racing toward AI dominance, Nvidia faces real competition, especially from China. At the same time, the US government is rewriting the rules around technology exports and tariffs. And in the middle of all this, Nvidia is making a $500 billion bet on an infrastructure play that could define the company's future. Though China's Commerce Ministry says the country is contemplating starting trade talks with the US, there are early signs that tensions could be easing between the two sides. Futures on the S&P 500 moved higher, with Hong Kong's Hang Seng Index jumping over 1.5%. So the question is simple: is Nvidia still a smart investment at these levels? Let's break it down. First, let's clarify this $500 billion figure. It's not coming entirely out of Nvidia's pocket. CEO Jensen Huang made it clear they'll be working with partners, building new factories, and onshoring manufacturing efforts to meet explosive demand for AI infrastructure. But this isn't just growth, it's a transformation only real investors can maximize for huge profits and for potential millionaires in 2025. If you're serious about building wealth through smart investing, don't just skip. Please us get this video to 500 likes, tap the subscribe button, and turn on the bell so you don't miss the latest market trend and shift. No hype, no noise, just the real story behind the markets. However, Nvidia faces risks. Its business could slow dramatically in an economic downturn. Its largest customers are working on their own chips. Competition and supply chain challenges are also things to worry about. Investors might be looking at other options. Is it time to forget about Nvidia and instead buy another AI stock right now? Now, this part should really concern you because it's not about speculation or headlines. It's coming directly from Nvidia's CEO, Jensen Huang. When asked about China's progress in artificial intelligence, he didn't brush it off or downplay the risk. Instead, he openly acknowledged that Huawei is advancing rapidly and described them as one of the most formidable technology companies in the world. That kind of statement from a competitor isn't just flattery, it's recognition of a serious threat. Huawei has been doubling down on AI chip development, improving its networking systems, and building competitive software ecosystems. And they're doing it with urgency. Despite years of US sanctions and trade restrictions, Huawei has found ways to innovate internally, source alternative components, and continue expanding its technological footprint. But it's not just about one company. Huang pointed out that roughly 50% of the world's AI researchers are Chinese. That statistic isn't just a number, it represents the size and strength of China's AI talent pool. These researchers aren't just working in labs, they're driving breakthroughs in deep learning, computer vision, generative AI, and large language models at a pace that's reshaping global competition. The truth is, while Nvidia may have the lead today, this is not a sprint. It's a long-term race with no finish line and infinite contest where progress is constant and leadership can shift with the next major innovation. If China continues to close the gap through sheer research volume, state-backed funding, and growing control over its tech stack, Nvidia's dominance could face real erosion in the next 5 to 10 years. And that's something every investor should seriously factor into their long-term strategy. Now here's the deal. Nvidia's headline-grabbing $500 billion investment isn't coming entirely from its own pocket, but that doesn't make it any less significant. CEO Jensen Huang made it clear in the interview that this figure reflects the total scale of infrastructure needed to meet the exploding demand for AI computing, not just Nvidia's internal capital expenditure. This massive build-out will involve multiple industry partners, third-party manufacturers, and in some cases, new Nvidia-owned facilities designed to support next-gen chip production and AI server deployment. The scale here is historic. Nvidia isn't just increasing capacity, it's trying to anchor itself as the foundational layer of the AI economy. We're talking about data centers, chip packaging, distribution networks, and possibly new vertical integrations that give them more control from silicon to software. From an investor's point of view, this is a bullish signal. It shows vision, conviction, and long-term strategy. Nvidia isn't reacting to AI trends, it's setting the pace. But the flip side is this: a move of this magnitude introduces real financial and operational risks. Construction delays, rising costs, and a potential mismatch between future demand and present investment could all impact short to medium-term profitability. And with Nvidia's stock already trading at premium multiples, even small margin pressures could trigger sharp investor reactions. So the big question isn't whether Nvidia will remain relevant, it's whether this huge bet will pay off efficiently, without weakening short-term returns or exposing the company to new supply chain vulnerabilities. Huang carefully avoided direct criticism of the U.S. administration, but his message was unmistakable. Nvidia is counting on Washington to create an environment that accelerates AI development, not slows it down. He emphasized the need for policies that don't just protect American technology, but actively promote its global diffusion. In his view, America cannot lead the AI revolution without isolating its innovations behind regulatory walls. While the intention behind recent export restrictions and tariff adjustments may be national security, the unintended consequence could be a stifling of U.S. tech competitiveness abroad. Nvidia relies heavily on international markets, particularly in Asia, where AI adoption is surging. If the government enforces stricter controls under the updated diffusion rule or further expands the list of countries facing limitations, Nvidia risks being cut off from some of its fastest-growing customer bases. That's not just a diplomatic problem, it's a business risk that could reduce top-line revenue and slow the global adoption of Nvidia's technology. Huang's call for thoughtful, forward-looking policy reflects a growing concern among U.S. tech leaders. Without smart regulation that balances security and innovation, America could end up ceding its AI leadership to more agile, less restricted rivals. So, what does all this mean for you as an investor trying to make sense of Nvidia's next move? The pros are obvious, and they're compelling. Nvidia is making a massive, long-term bet on the future of artificial intelligence, not just by designing faster chips, but by building the physical and strategic foundation for an AI-dominated world. They're locking in key supply chains, investing in domestic and partner-led infrastructure, and aiming to be the go-to name in every layer of the AI stack from raw compute to software ecosystems. At the same time, demand for AI chips isn't just growing, it's exploding. Major players across healthcare, automotive, defense, cloud computing, and finance are scaling up their AI needs, and Nvidia is often their first call. But don't ignore the risks hiding underneath this expansion. China is catching up fast, and competitors like Huawei are no longer distant threats. They're actively pushing toward parity. U.S. policy adds another layer of uncertainty, especially if tighter export rules limit Nvidia's access to key international buyers or create frictions in their global operations. And then there's the financial strain. No matter how well planned, a $500 billion infrastructure push inevitably creates pressure on margins, especially in the short to medium term. So, while Nvidia's long-term vision is bold and impressive, its success isn't guaranteed. As an investor, you need to decide whether you have the conviction to ride through the volatility that could come with execution risk, global policy shifts, and rising competition, or whether now is a time to be cautious, lock in profits, and reassess as the story unfolds. Note, I acknowledge the potential of NVDA as an investment. My conviction lies in the belief that AI stocks hold greater promise for delivering higher returns, and doing so within a shorter time frame. There is an AI stock that went up since the beginning of 2025, while popular AI stocks lost around 25%. If you are already holding an AI stock that is more promising than NVDA and probably trades at less than 5 times its earnings, let us know in the comment section. Please share and like if you find it worthwhile. See you in the following video.